discussed. Absolutely must be discussed. Who commented on this? Let me see. Oh, let's make sure the chat is open.
Hey, everybody. Wow, what a day. That was pretty nuts. We finally got the result of a little bit of exuberance, right? So we saw a couple of interesting things this week. As you know, in Leap Trader, we're playing the AI theme. We've got a little bit more core. So in our newsletter last week, we talked about moving a little bit more into real stuff, not abandoning AI at all, but moving a little bit more into the real world as this sort of the benefits of AI kind of spread throughout the broader economy. But for today, there's no question we had a massive, massive sell-off, and I'm going to show you guys a couple things that I've been talking about, because this is something that started to get me nervous, right? And so with options and volatility, these things can serve as tea leaves, right? So as you're reading the tea leaves, you watch markets, you can look at moving averages, you can look at volume, you can look at whatever indicators you like to look at, but options and volatility give you that extra little bit of information, right? So let me show, I want to show my screen here. As people file a little bit. So by the way, I'm Hans, Options Hans, 15-year pro market maker, and then a decade managing a whole bunch of income funds, downside protect funds, Black Swan type stuff. So everything we talk about today is for entertainment purposes only. And if you're okay with that, keep watching. And I want you to keep watching. Hey, good to see you guys. Thanks for coming. I thought I would just kind of do this impromptu. I'm going to start doing this sort of every week, maybe once or twice a week, especially if things get a little bit crazier out there, which they're crazy no matter what, right? They're either crazy on the way up or we get a little pullback like this, which has been sort of, coming for a while now. So let's take a look at some of the signals I've been looking at. And anybody in Leap Trader, hey, sorry guys, I pressed the wrong button there. I pressed the wrong button. Okay, so let's take a look at something that I found very, very curious. So, right, let me show you how volatility can really be your ally and giving you a little bit of insight. And I've talked about this, if you guys have watched my videos since last year. I've talked about it in the Bitcoin space, especially in MSTR and things like that, because we get sort of big moves in volatility, right? That's what makes those products kind of fun, is that you get the reactions a little bit more pronounced, and you can kind of appreciate some of the behavior that you get out of options volatility. So look at this. This is micron volatility right here. So when I say volatility, I just mean option pricing. Okay, so I'm gonna move this screen over here. So when I say volatility, so that just means, that sounds like, that's kind of like floor trader speak for what's the option pricing. I don't mean movement unless I specify it. If I say, oh, realized volatility, historical volatility, that means actual movement. But if I say vol, oh, look at vol, what's vol? If I look over at another trader and I say, hey, what's the vol on Micron? I'm asking him, what's the price? What's the implied volatility? And so look at what we've had. I want to show you near-term volatility in Micron. And so of course, anybody follows me, I put out a video. I said, I really love this name. I love what they're doing. I think there's going to be a shortage. Actually, just today, we started to see more and more articles on shortages in the memory space. And so let me show you. This was some VIX stuff that we did. We bought some VIX, some SPY put spreads over the last little while. Here's my non-negotiable strategy kind of stuff, right? We've got rare earth stocks jump. That's that area where I feel like, okay, there's a lot of really, really interesting stuff going on out there. So here we go. SSD and RAM pricing apocalypse, right? There's just going to be a shortage of this stuff, the DRAM, stuff like that, SSDs. So that's why a lot of these companies, STX, Western Digital, Seagate, and Micron have this sort of advantage because they have this amazing pricing power. And so I've been kind of very bullish on this area, and look at what's happened. So this, back when I got bullish on longer term options, was sort of in here. This isn't even the right chart, but we can see that short term options volatility has really exploded. And I want to show you how pronounced that has been, right? So when we looked at these options, when we started putting these on, it was back in here. So in August, September, we started to add a little bit more after earnings because it still didn't get very high. So I want you to notice something very interesting about option pricing here on Micron. When did we see something like this? Look at this big spike in how option pricing has moved. Big spike up, very similar to what we saw in April. But the difference is the complete opposite in terms of what the stock did, right? What happened in April? We were crashing. Right? The market was selling off. And that's the normal relationship that people understand. Option pricing goes up, right? If you want to insure your home, once the roof is burning, the insurance company is going to say, well, you're going to have to pay a little more for that insurance. So when things are falling, then option pricing gets high. The cost to insure gets high. That downside put spread usually pushes up. That means the puts get quite expensive, which we saw back then, massively expensive puts. As the market sold down to 5,000, even lower. What did we see this time? Well, we saw a crash up, right? See, that is what has been going on in markets lately, is that there has been a resurgence in the realization that AI can potentially do all these amazing things, but also disruptive things, right? Can cost jobs, can be very disruptive to companies, to big companies. Vinod Khosla said, by the 2030s, we're going to see the S&P 500 is going to look completely different. There'll be companies falling by the wayside because they won't know how to react, or they won't have any choice, right? It's not necessarily their choice in the matter. Their AI just may eat everything. So we can see that we've had this crash up in option pricing. And I was on Oliver Rennick's show and I said, listen, I really still love Micron. It was, I don't know, 181 at the time. And so it ran up ran to 194.95. And I said, that's it. I said, I still like this name, but what I'm seeing is a lot of exuberance. I see a lot of excitement in option pricing. And what else did we see at the time? We saw option volumes, retail option volumes go like this, like parabolic. So with those two things, now I had already been selling off positions and adding hedges in Leaps Trader, over the last few weeks. As we've moved up, I've been selling out of Soxal and Sox and things like that. And then when this volatility exploded here, I said, look, this is starting to show a little bit of exuberance, right? So I like to get in when there's a little bit of excitement. That's what option skew can show you, right? When those upside calls start to get a little steeper, that shows you that there's something exciting happening. The things are in motion. They're in motion. And that's what you want. You want to play the early phase of things are in motion, meaning stocks are melting up, parabolas are forming, they're catching up on stocks that they've forgotten about a little bit, not forgotten about in Micron, but that, basically are a reasonable valuation and are going to be in the right place at the right time for memory. And so we saw this very big push up, and I sold my positions. I sold out of all my calls because not only had I made money on delta, so I want you to understand this, that you can make money on long delta, which is basically your long call, your short puts, whatever it might be, long a call spread. You're going to be long delta. So you can make money on delta, but you're also going to make money on that big expansion of option pricing. That's called Vega. You have Vega exposure. Now, I had a couple of positions on USAR, for example, because I've been pushing this idea that this is non-negotiable stuff, right? And USAR has doubled now. But I said, listen, this Intel, those kinds of things are non-negotiable in the sense that the government has to shore these things up. And we're starting to see that play out in a very violent way in markets. But we were talking about that a long time ago. This is non-negotiable. There are not going to be enough rare earths. They're actually not that rare, but they're hard to get out of the ground. and we are going to need a lot of them. We are going to need a lot of power. There are going to be power shortages as this infrastructure build out expands. So there are going to be supply chain problems, and the market is going to start to realize that at some point. So we're going to have to be a little bit careful, because if we can't build enough, if we can't acquire and secure those kinds of things like rare earths and those inputs, it's going to extend to copper and other kinds of things we're going to need. But this is a sign that people got over exuberant. So I said, this is it. We're going to continue to sell off these positions. Not that I don't like the name. It's that we are playing two games, right? We are playing a number of games, really. It's an idea. It's a secular theme of AI. We're playing the specific stocks that we think are going to do well. I said Micron would do well and Broadcom would probably not do great. And that's what happened. Broadcom just kind of went sideways and Micron went up. And so there is some element of finding out where you need to be. In many markets, in a mania, probably all boats are going to float up. But you do want to be a little bit more selective. So this was a sign of froth, and option retail volumes absolutely parabolic and off the charts was another sign of real FOMO out there, right? So we had this move in the market from 6,400 to 6,700, and we finally saw that play out as it was sort of all in. Everybody just went boom. All in, which is going to create that midterm top. Now, I don't think this is over. I think we continue up, but I went to, and I talked about it. I was on my show with Samantha this week, and I said, yeah, I've gone to about 30 to 40% cash, and I've moved out of the high beta stuff, right? So what does that mean? I'm not as concerned about an Apple, right? When there's a mania, I want to play a mania. So I'm going to have core positions, but I'm going to be playing the super beta, right? The super beta stuff to supplement all the sort of core positions that I have. But I said, listen, I'm almost out of all of my super high beta because I think that's where things are most vulnerable. Now, of course, MAG got hurt as well. But I also said I'm moving out of, so these are some things for you to think about for next week and going forward, is think of some of the things that may continue to have some resilience. So when I look at, I said, listen, I'm getting out of equipment. I said this on the show. I said, I'm getting out of equipment because it's had a pretty good run. And I am now pivoting from the building the physical structure of AI and AI inference, which won't stop, but the focus has really been there. And I'm sort of feeling like there's maybe more opportunity in the data space. So I've got my three horsemen of the data apocalypse, which is Snowflake, Palantir, and Datadog. We'll have Databricks at some point when it goes public. But for now, those are the big ones, right? There are other small ones, but those are the big ones. And so I think those are ones that you can kind of focus on, because I think when the earnings start coming out, I think you're going to see very similar to what we saw from Snowflake last time, which was kind of blow your mind. This is amazing stuff, amazing revenue retention numbers. You know, customers aren't just signing up, they are staying and they are spending more and more and more money every year. That is what you want to see. So Snowflake, for example, today, not including after hours moves, was down 3.5%. That's a 1 beta to the NASDAQ. That's pretty good, right? So normally those huge beta type stocks are going to get killed on a day like this. As some of my other holdings did. There were some other ones that did get hurt. Figma, for example, which I added to in the aftermarket. So that, I think there's a little bit of resilience there on the data side, because while the equipment side may have some element of a caution in my mind, just for now, I think the build out continues. I think it's kind of maybe gotten a little bit ahead of itself, even though I don't think Micron and Nvidia are that expensive. I think we're going to start seeing the other side of the coin, which is we are creating massive amounts of data and companies are going to clamor. So I'm thinking of what might be a little bit more resilient. Not that semiconductors are very cyclical anymore. I saw somebody write that the other day and I said, they're not really cyclical, right? You're building out the new infrastructure. You're building electricity. You're not going to stop generally because of the ups and downs in the economy. So this is happening. And so I think the data area is quite good. Let's look at some of these other areas here. We've got We've got the VIX, of course. So I want you to be able to watch that, right? I think at some point I have a link that you can use to get into bar chart. And if you get it, let me know and I'll get you an extra 2 months on that. But bar chart's going to allow you to look at things like this. And it's very granular. You can kind of get in here and look at different deltas. You can look at different terms, to different expiries, tenors, as we call them. You can see here, Micron, the percentile ranks. You can get an idea of how high is volatility. How high have option prices gone? We've gone from almost zero all the way up to, 60, 70. So option prices have gotten expensive. And what that means is you've got to be a little bit more careful with how you do things. That's why I got out of my Micron calls, because I now made probably over a third of my money from an expansion of option volatility. I mean, from the rise in the relative value, the implied volatility. Now, as I and I'm going to start looking on Monday, this is one of the names I'm very interested in. So Micron down in the low 170s, high 160s. I'm very, very interested in that. Because I think that's an area where you're going to see a bit of a panic, and Micron is not expensive, right? It's trading, it could get back down to where it's sort of its 10-year average forward PE. And I know it sounds crazy to talk about PEs because it doesn't apply to some things, right? You look at Palantir, it trades at like a 500 PE. Does that matter? Well, no, that's really much more of a story stock. I think Snow's a better version of Palantir, but Palantir is like, that's the king of the three horsemen. So Micron's going to be one area where I want to rehook some of those positions. But the problem is, when Micron comes down, it's probably going to be associated with a market that's coming off, and the VIX is probably going to be 23, 24, 25. And even though this is 1-year option volatility, VIX doesn't apply to this, but that these option prices are not going to get cheaper, not much cheaper. So the horse is kind of out of the barn now, right? We are in a new regime. We are no longer in this level here where I said, this is crazy. I said on every show, I said, this market is just not pricing in what could be happening, good or bad, up or down, disruption, earnings. We have no clue what earnings are going to be. We have no clue about tariffs. We have no clue about all kinds of things. The market was not pricing that in. Now it is, right? So now we have to start looking at different ways of doing things. And that means when I look at Micron on Monday, for example, if it gets down to the low 170s, I will start looking at call spreads. And the reason that you start looking at call spreads is because you have this very high volatility that you're strapping on. If I were to just go out and buy out of the money calls again, I'm going to be risking the compression of that implied volatility. And I don't want that Vega exposure. I want to minimize it. I can't get rid of the Vega exposure totally. I can minimize it. I can do like a call spread. So let's take a look at this. This is how I might position myself on Monday if we do get follow through to the downside, which I think we could. We're seeing a little bit of a selling in the aftermarket. We saw a big crush in the coin space, in the crypto space. So there's nervousness out there. It could very well follow through. And I said that today. I said in the community, I said, listen, I've got it's called the VIP trading floor community. And I also have Leaps Trader for anybody who jumped on. And crypto trader. So I have various services, but in the community, the SPY was down 8 today. Now, what has happened over the last few months, every time the SPY is down, it bounces back, right? They reject every sell-off and they buy the market like Pavlovian dogs. Today, it was different. And I said this week, we could close on the lows today. This feels like a close on the low day. And that's exactly what happened. It was a little bit of a strange premonition, but it felt like after all this time of almost not having a downtick, this was not going to end very, very easily with the Trump news, with what's been going on today. Which has an impact, right? 100%. I mean, look, this is probably this is the art of the deal again. And there's going to be a negotiation. There's going to be a lot of saber rattling. We've been down this path before. He does not want the stock market to crash. He just doesn't. So I think I think cooler heads will prevail. But what I would be doing is I'd be saying, listen, options are very expensive in Micron. At this point, I might just go out and buy the stock, right? When options are too expensive or it gets too complicated, I might just buy the stock. Or what I might do is I might position myself in some in the monies, which are still they're still gonna have vague exposure, right? So it's not always the best way. But if I were to go into Micron and say, let's say we're at 170 today, but we're at 180. So let's say this is 170. So I'm going to get in here and I'm going to buy maybe something $10 out of the money, and I'm going to spread it out with a vertical. So let's take a look at what this looks like. So I'm going to buy the 190 200, which would be the 180 90 if the stock is at 170. Option pricing has really taken off, and we can see now that you create this exposure. So let's look at the risk gauge. I hope you guys can see this down here. Oh, hey, Stacy. Yeah. Hey, I remember you from last time. Yeah. Today was crazy. It was actually crazy. Yeah. So I was adding puts. So in the community, I said, yeah, I'm adding more of the, I think it was the SPY March 550s, the SPY March 550s. A really good student of mine said he's been loading up on teenies, which is those really, really cheap ones, which I kind of like. Like if you go way, way out of the money and you pick up a whole bunch of these way out of the monies, you're going to get exposure to a push up in volatility, but also something called VAMA. VAMA is like the reactivity of Vega to a sell-off. It's going to be like almost like the steepening of a skew. So what happens in crashes in April is that those little tiny cheap ones, even though they're super, super out of the money, you may have paid $3 for them, but they're suddenly worth $30 because there's a huge steepening of skew and they just go bananas. They're little lottery tickets that are suddenly people are panicking to buy, to cover and to buy. And so that's what makes the teenies kind of powerful. And you can buy, if I buy a way out of the money put for $3 versus something closer to the money for $8 or $9, I can buy 3 times as many for my budget, right? I can spend $9 on a put, or I can buy 3 times as many for my $9 if the put is $3. So it's further out of the money, but it has that massive skew up possibility. It's not going to help you as much right away, but if things get ugly, you could really see. And if things get super, super ugly, you're going to get that. You have those extra contracts, right? You're going to actually, you could potentially, the way I used to set it up with my Black Swan funds is I would set it up so that I would actually make money in the event of a massive crash. I didn't want to just protect my positions, my S&P holdings or whatever it was. I wanted to play so that I would win in a 2008 type scenario or a COVID type scenario. So look at what happens here. Let's say I've got 10 contracts. So this is going to cost me $3.43 to play that $10 upside move in Micron. That's going to cost me $3,000, $3,400. And I want you to notice something here is that my Vega is 13. You see the Vega? It's about 13. So if volatility stays the same, I'm going to be okay. If volatility gets a little bit compressed, I'm going to get a little bit hurt. But watch this. If I put on simply, let's say a 200 put, let's say I buy 10 of the 200 puts. What's my Vega? 227, right? Versus if I spread it, look what happens to my Vega. It goes, I'm comparing owning a November 200 call versus a November 190 200. One is a spread and one is simply an upside call. But look at the difference. My Vega is 13, very little Vega exposure. So if volatility compresses, if option pricing compresses, then I'm not going to get so hurt. If I own the 10 of these calls, I have massive Vega exposure. I'm still going to make money on the way up, but I'm going to potentially give back a whole bunch to that Vega. So what happens when we're in a higher volatility environment or an environment where you have skew, right? The out of the money call skew, the out of the money put skew, maybe those are pushing up. Now we have very expensive. I showed you the micron, right? That's part of that is skew. Part of it's the whole curve going, uh-oh, you know, this is a new world. We need to price in many possibilities. But another part of it is those upside calls getting very, very excited. That's what got me a little nervous about it. That's why I said, okay, I love the stock, but I got to get out of this position because I'm willing to wait. And it dropped $8 and then it ran up $11 2 days ago. And I thought, oh, I guess I was wrong. Maybe this is going to keep going. And then of course today happened. So the idea is that given the environment, and this is what we do in various programs, at this point, as we start to play upside, I have to be much more careful. We don't have that low-hanging fruit of like super multi-year low option pricing. That was the best. That was like Christmas every day. I'm like, how are they pricing everything so low as we're on the verge of a breakout in a mania from AI? Well, the reason was that the rest of the market didn't believe the mania, right? So you kind of have to have a bit of a premonition, which came to fruition. But now Christmas is over, right? Now we've got to work a little bit harder and be a little bit more cognizant of how to play these things. Now, I'll show you another really cool way to play the upside in micron. So there's this way, which is just straight up call. And it shows that if we get a move back to those highs of, let's say 195, you're going to make about $5,000 on a 10 lot. That's pretty good. You're going to make about 130% on your calls if it happens relatively quickly. But the problem is volatility might get compressed. It may not, because we're in this environment where craziness can happen. So we may be at higher levels of volatility. I said this earlier in the week. I said, somebody asked on the show, they said, do you think we could get down lower in the VIX? I said, it's really hard to get the VIX down when you have a mania developing. It's very cheap at 14, 15. And I didn't know it was going to happen today, so that helped. But the thing is, that's a very low level for a market that is now starting to recognize the upside mania potential, as well as the downside risks of tariffs, of perhaps sticky inflation, of something else breaking, something to do like remember we had the Japanese yen carry trade. Things can happen. The credit markets. We're already seeing some of the private equity areas get hurt. So there are things happening a little bit below the surface, which hopefully can be contained. I am a big fan of the money center banks. So I love the Goldman. I've been playing Goldman, not JPM, but I like that going into earnings. I think that's a great place to be if you believe in the broadening. So what I said was, before I show you this, I said on the show, I said, listen, I'm moving out of the physical. So a little bit less of the SOX, the SOXL. If you guys know my stuff, you'll remember the SOXL trade. So it's gone from 17, it went to 42. I sold the last of mine around 41.25. I sold a whole bunch around 35, but I sold the last of it around 41.25. So I was out of that position. I don't mind reloading them, but the problem at this point is, if I show you a chart of SOXL, this is not what you want to see, right? So when you start seeing this, here, let me show you the SOX instead, because the SOX is what SOXL is based on. So when you start to see more of this, which is, what is this? Realized volatility. This is movement. Now you start to bring into the forefront one of the negatives of these products, right? The negative of these products is the daily decay. What happens when you have a big up move? They've got to buy a whole bunch of underlying exposure in the swap. It's a swap product. They need to create upside exposure, because tomorrow they need to get 3 times the semiconductor exposure. So they have to push into that product. What happens when they sell off? They have to get out, so they reduce exposure, because otherwise they're going to lose too much if it continues down. So I'll show you guys the video that you should watch to really understand this. Let me show you this, because I think this stuff's really important. So let me show you. Forgive me for sliding around a little bit here, but I want to show you. Oh, Dan Nathan, he must be just having a ball today. I really like him, but man, he. Oh, here I am talking about 𝐶𝐭. Here we go. Here it is. Okay, so I want you guys to go and watch. If you don't understand these leverage products, you absolutely have to watch this video. It's 𝐶𝐭 options trading secrets, what every trader must know. So this is something I did last fall. I've done probably a couple of other videos on this similar concept, but this is going to show you the way that these products work and how they get chopped up by lots of daily movement. Daily movement literally chops them up. That's money that doesn't come back. So you have to be very careful. So my whole thesis behind 𝐶𝐭, in case anybody's watching and maybe did the trade or has the trade on, you need to be aware that when these products, let me show you, when these products are getting smoked like this, when 𝐶𝐭 went from 70 down to 8 with lots of volatility, remember we had a large period of movement in semiconductors, a lot of negativity, CapEx spending at that point was, everyone was wondering about it. Even I got a little bit negative on it for sure, until I started to realize the power of inference. And so in here, you're going to get that product's going to get chopped up. The reason I got back in is because I started to understand what was happening in AI. And I said, listen, this is going to probably go to 40, 60, 70 bucks. And so that's what it's done, but without a lot of fanfare. Do you see? It's done it with not a ton of volatility. You haven't gotten this and this and this and this so much, right? You haven't gotten consistent, massive volatility that chops up these products. So now if we are transitioning from these products were great when things go in a straight line. They're going to be great. Somebody on Twitter was talking about how you're guaranteed to not make money over time in these products. This is stupid. People just talking about stuff they don't understand. Of course you can make money. Look at this thing over the years. This thing has been around for like 14 years. You've made a fortune on it many, many times. And so it does not automatically go to zero as time goes on. But there are going to be periods where there is a lot of risk. When you start to see these kinds of moves, you're bringing in the possibility that the negative from these products is now starting to get a little bit more entrenched. So I want you guys to watch that video if you want to know more about how that works. Now, let's get back to our Micron. So we can do this call spread, which is going to, this is this simply straight up call, but we're going to get maybe that Vega exposure. Now, maybe not, right? Maybe we won't get hurt if the market rallies, because I mean, probably we will a little bit, because you probably will see the VIX come back down in the sort of 17, 18 range, and it should affect some of the longer term options, but maybe not, because we're seeing such strength in those long-term options, which you have to understand that when you start to see that kind of strength in 1 year, 1.5 year, 2-year options, that's very unusual. You do not typically see that unless the market, the powers that are behind the flows that push those options up, they are realizing that something big is happening, right? So it's no longer a secret, like perhaps it was a couple months ago, that this is going to be a new and very rapidly changing world and regime, with a lot of winners and certainly some losers as well. So markets are starting to recognize that, even though the VIX was down to 15 and 14, even though credit spreads have been tight, even though rate volatility hasn't been very high, we are seeing worry in the long end of options. So that's, to me, that's very, very fascinating, because you don't see moves like that in those options. So now let's put in the vertical. So here's your vertical. Now this is what your vertical looks like. So you can make money, not as much money to the upside, right? Because you've spread it out. But what you've done is you've reduced your Vega exposure, right? So you're now starting to play in a world that is higher vol, skew all over the place. And you're limiting your risk here, right? You've limited your risk to $3.40 instead of paying this $8.55 for 10 of the 200 calls, for example. Now you could lower that, right? You could say, well, maybe I'll only buy 5 of these, and then you'll have kind of almost like a sort of a similar spend. You're going to have 114 Vega on the single call, but look what happens with the spread, 13 Vega. So even when you reduce the amount spent drastically to make it almost similar, you still have this big Vega component. So that's really the whole point of this long-winded explanation is that we are now in a new world where you're going to use different strategies. I want to show you one other thing that we can do when we get high levels of implied volatility, and we're worried that they could come down as things maybe stabilize into Christmas. You don't want all that Vega exposure. So like I said, I got out of the Micron. It wasn't so much a call that I thought the stock would come down. It's that I thought things got a little bit too excited, and I've made all this money on that Vega, on those options really expanding. So I said, look, I can sit out of it, right? It's not that I went to about 30-40% cash. I did start to deploy a little bit into IWM. I'm starting to think about other areas, healthcare, certainly industrials, right? Like if you look at things like Caterpillar, like they've had good runs. It's not like this build out has been a big secret, but look, I think Caterpillar, if it doesn't fall apart sitting around this 9 EMA, which by the way, I love this 9 EMA. So make sure you have your 9 EMA on your chart, because in a strong uptrend, you really see it respect. Look at this. It goes up and then it reverts back. You can kind of tell sometimes you get too far from that 9, and then we come back and we touch, and then we get a little bit too far again. We come back and we touch the 9, and we get up there, and now we've almost touched the 9 again. So I'll be looking for this here to potentially get back into, what was the other one I wanted to do? The industrial. See, here's the industrial. So this has had a good run here. And this is interesting to me, right? Like, I think it's interesting. It's my MTI's gone completely red. So it's not like a green light sort of situation, but you can see that it's really kind of fallen apart over a couple of days. I may look for this thing to kind of base out in here. I'm not a big fan of catching a falling knife. I'm more of a fan. Somebody said, well, should I start in the community? They said, well, should I step in here? Are there opportunities? I said, I'm going to wait. In fact, what I said was I prefer to get into certain things when they start getting to new highs again. Now, I may not wait that long, but I am a believer in jumping on a horse that's going in the right direction and not standing in front of a horse that's about to run me over, right? I'm not bigger than that horse. I'm not bigger than this market. So I like to wait for things, even if I miss the bottom. I like to wait for things to kind of find a level. And that's a really big thing with options. You really want to think that way. When option pricing is just going straight up, that's not when you want to get big on your option selling strategies. Right? You want to look for things to kind of crest and calm down and maybe start to even pull back a little bit. And even though you're not going to pick the high, you're going to be on the right side of that mountain as volatility starts to come down. You're going to be selling into probably strength in the market, which is number one, if you're selling cash secured puts or something like that, or doing out of the money covered calls, at least you're going in the right direction. And number two, volatility is also going in the right direction, right? Right. If you sell options, if you're a big seller of options into a big sell-off, you've got the market going against you. You've got option pricing going against you. You're selling into you see a storm coming right towards you, and you're going, well, okay, I'm going to sell you a whole bunch of house insurance, even though the eye of the storm is about to hit you. You kind of have to think in those terms, right? There's nothing wrong with sitting on your hands and going, okay, I'm just going to wait a little bit and wait for things to settle. So this could maybe settle. I want to see it. I want to see it kind of sit in there. And I'm a believer in this sort of build out in infrastructure that's gonna continue. Another area I think is kind of interesting is that the three horsemen of the data apocalypse that I think are just doing all this fantastic stuff and are going to continue to just absolutely kill it on earnings, which is Snowflake. Palantir, I haven't had a position on in a little while, just is so damn expensive, but no question, if there's a real mania, that it will participate because it's an incredible company. There have been reports that people are presented with what they do, and they literally are speechless for like 10 minutes. They're like, I can't believe what you guys are what kind of value you're delivering to us. So these companies are really starting to move the needle for industries. And I think that total addressable market is just massive, right? It's just massive. And what are we creating in AI and AI inference? It's just more data than we're going to even know what to do with. We're going to need companies to come in and take those silos of data and figure it out and crunch it. And these guys can come in and go, you're going to save money here. You can make money here. Here's something you had never thought of. It's just, we're moving into a world where data is really going to kind of run everything. So those are a few ideas I like. I think Snow actually did okay. It was down maybe 3.5% today. That's a nice 1 beta with the NASDAQ. That's actually a good performance, believe it or not, because there were some stocks that did a lot worse than that. I'd be looking for maybe just a little bit more pullback in something like Hood. I think Hood down into maybe the high 120s, maybe 130 might be interesting. But again, this is stock that's gone from 100 to 150 in an instant. I said that today in the community. I said, be careful. Don't be a hero today. You have stocks that have gone up 50s to 75% to 100% recently. It's not hard for that to unravel a little bit. I am bullish on the market, but if we are in a period where things kind of have to just sort of work themselves out a little bit, then, you should let that happen, right? Unless you're fortunate, you have you're 100% cash, then, you probably want to go and start picking your spots. Goldman, I think their numbers are going to be unbelievable. I think this is one of my favorite stories out there. This is the 𝐬𝐮𝐞 started to look really, really good at one point today. Look at this breakout here. Man, they were starting to move into those data centers. And I kind of got out of most of those positions. Not that I'm super negative, but because I wanted to move more into a little bit broader, a little bit more data, a little bit more real touchy-feely kind of stuff for now. It doesn't mean I can't jump back in. I do own NVIDIA. It's cheap. But it doesn't mean I can't jump back in. But for now, I'm just trying to position. I own a bunch of Google, which I think is actually, really reasonably priced and will be one of the best AI stocks. I know it's hard to believe you're hearing that from me. I think Apple is still one of my favorites, even though it came off today. I think they're gonna kill it. I think that's, for me, I'm gonna be chipping away at Apple because I think that's the premier AI in your pocket play. And the new phones are selling well. And these guys don't even have to be very good at what they do anymore. They're not. But they're in the right place at the right time with a phenomenal brand and ecosystem. And the world is going to come to them because they already have a massive captive audience. And then at some point, they're going to get something right. And then that's going to juice them even more. So I just think it's kind of a can't lose because AI is not stopping and people want to be a part of it. And so they're kind of right there at the right time. It's not a cheap stock, but I think they're right there at the right time. Reddit is one I did a video on. If you guys saw it, I talked about it around 100 and I don't know what it was, $140. It went to 260. I sold it out of my long-term portfolio at 260. Now it's kind of sitting down around 200. I think that's interesting. I want to do a little bit more work on it. Crypto, I don't have a ton of exposure to. I do have some. We run Crypto Trader, Income Trader. I have been doing some more income trades there, right? So we had this little run up in crypto, and I did a couple of trades in crypto Income Trader. One was a straight up cover call, but the rich man's cover call, right? So against leaps. And then the other one was a turbo cover call, which I call it the turbo cover call because you do like a spread. You're kind of long the underlying, you do like a 1x2 and you create this amazing amount of upside and you do it for a credit. So you do get a little bit of that, extra juice from the call sale. Not as much as you do from just a standard cover call, but it is more bullish, which it did not work out. But it's a little bit more bullish because it grabs more of that upside if it happens. You're putting it on for free, right? You own that underlying. You're putting on this turbo portion. It's like you tack it on there like an accessory, and if it does well, you do great. There's a limit, but if it pulls back, you put it on for nothing. So those are really, I love those ratio trades when you get those nice high vol, high skew, and then you can kind of play that. They price really well. We did that on USAR, right? So if you guys watched that video I did earlier in the week, I think it was, I said I did a turbo in there, and it priced nicely. Now, Marcus was talking about the skew. It wasn't as nice, but it was like it had this vague exposure, and so you got this 27.39 call spread by financing it with something way out of the money in an area where I keep saying it's a non-negotiable. We have to pull rare earths out of the ground in these locations where these companies are. So MP, USAR had great days, even with the market off massively. They were up on the day. So I think those are still very interesting plays that you can look at. So that's kind of the plan. I've been adding a little bit of Netflix in the after hours. I added a little bit of Netflix because I love the safety. We did 𝐶𝐨𝐬 the other day. I think that's a safe play as well. They almost can't do wrong, 𝐶𝐨𝐬. I mean, it doesn't mean the stock can't go down, but that is a company that's just firing on all cylinders. Tesla, I'm definitely getting hurt on. I have some upside call spreads. We have an upside call spread in Leaps Trader that's taken some heat. I have a bunch of other kinds of positions there, but I still think that is one of the premier AI, robotics, and automation, and people don't think about it. That even though cars are making a bit of a comeback, I don't care about cars. You may at one point if they start to pick things up there, but I think it's one of the great power gen areas. Elon with his power blocks and all these things that he does, they are selling. People don't even talk about it. He sells like 1 million of these things, and he is absolutely in the sweet spot for, helping to create power storage, power solutions in a world where there just isn't going to be enough power. So that gets me excited. But I tell people, look, it's going to be volatile. You just have to decide what makes you comfortable there. And then, of course, there's Figma, which I'm going to do a video on this weekend. I just love this play. We got in here down in the low 50s. I did get some in the mid 50s, then in the low 50s. And we had this really, really nice run. I barely sold any. So I'm a believer in this. I think the numbers are going to be fantastic. I picked up a little bit of stock in the after hours when it dipped down to 59 something. So I'm kind of adding a little bit more and really kind of looking for this thing to do well. So there are a couple names where I feel like it doesn't matter to me if the market is soft, because I really, really have conviction that these guys are going to continue to put up good numbers, and that's going to win out over time. So in a market sell-off, you want to make sure you're in those names. And that's why I said on my show, I said, listen, I'm getting out super, super high beta, except for things like Figma, super, super high beta, going and keeping the bulk of my holdings in solid balance sheet names like the Googles and the Amazons and the Apples, and a little bit of Microsoft. And I'm going to hide out in those areas because I know that they're really at the forefront of what they do and they're making money. Now, I may look to broaden out a little bit into, some other areas. I talked about industrials. I think those are interesting. You could even look, if you're looking for safe places, look at a fund called SPLV, right? So the SPLV is the low volatility ETF. So you can see it had a little tough time, but this has sort of consumer staples. It has some of those safer plays, some of those dividend plays even that are just going to sort of weather the storm a little bit, even though we can see that, there's some consumer pressure. People are going to need their Tide. They're going to need they're going to need to Febreze their home, I guess, which I don't get. I've never done that. Anybody like Febreze? I'm sure it smells good, but isn't it kind of weird spraying chemicals all over your house? I mean, this just seems kind of weird to me. It's like having a deodorant for your house. Like you're sort of wafting in deodorant. It's kind of a weird thing. But I think that's kind of an interesting place. We'll have to see if this continues to be a difficult market. I think that's a nice place to hide as well. And then, cash is never a bad place to be too. But other areas where because I sold a lot of high beta, well, guess what? I sold my ARK. I sold my 𝐴RK. I would be very interested in ARK, probably down around the 80 level. And especially, I think 𝐴RK is very interesting. Look at that. It's just kind of riding up that 9. It keeps popping through here. I don't know if the 9 is the best for this one, but maybe this one down in kind of the 28, 29 range. That might be a spot because I am excited about AI, health, biotech. I think those are areas that could have that nice combination. I love those combinations of a little bit of real world and a little bit of digital world, right? Like that's what I kind of like about Apple too. It's a little real, it's a little digital, it's a little AI, it's a little, it's a combination of those things. Amazon's like that. They have real world, and then they have this incredible cloud business that's just probably going to kill it for a long time. So something like, maybe even a bit of healthcare. Look at the run they had this week. Eli Lilly, Pfizer. Look at Pfizer. I mean, this thing went parabolic, and it's coming right back again. You know what? I hate Pfizer. I think they're just like scumbags, but I have to say that they may be in the right place at the right time, and you get a dividend there, right? So if rates, they may not come down as much as I originally thought, but if rates kind of are a little bit, are coming down a little bit, you get the healthcare, you get a dividend. I don't think it's a stock that's going to like triple or anything, but these are some of the places you can kind of move into if high beta, zero dividend stuff isn't your cup of tea anymore. So those are some of the ideas that I'm looking at, and I better get going. But thank you for watching. Okay, let's see who's here. Let's see. I'm going to take some questions now. You guys go ahead, fire off your questions. Let me know what you're thinking about the market. Oh man, really? How did that happen? Well, there we go. Today was crazy. You know what happened? The screen broke down, and then the thing, I logged out and then I logged back in, and well, there we go. You know what though, guys? Hit the alarm. Yeah, I know exactly. What are the most basic things? You can learn to frickin' turn the sharing on, right? I'm like Mr. AI, but I can't turn on my stupid screen. That's really a pisser. I'm very, very sorry about that. I hope some of the crap I said made some sense to you, but let me take a look. Oh, I never showed you guys the there's your MP. Here's MP materials. This is the one that the US government already pushed into. Look at that vol just going nuts. Look at that option pricing going crazy. And then, of course, I'll just show you a couple of things that I was talking about. Here's that MU, which is that micron. So I'm talking about doing that call spread, right? So you have that Vega exposure. At this point, look at what you're dealing with. You've got these options. I mean, you never see this. The vol option pricing has gone up more sharply and faster than even, well, April was pretty fast. But look at this. This is a very, very pronounced move up in option pricing that you'd never see outside of a sell-off. So what is this? Well, this is telling you that the world is changing, right? So this is important. This is a market that is now recognizing the possibility for all kinds of things happening out there. So you're definitely on board. And then that was also a sign, as I talked about earlier, that things got a little bit frothy and the option volumes went a little bit bananas. So that's why we got out of some of these things. Now, I am still in some high beta, but I'm in a lot of like lower tech. I'm in Domino's. I'm in, a bit of a Costco, Netflix, things like that. So I mean, a little bit. But what I'm going to do, because I said, listen, I'm a little bit off of high beta because it just went too parabolic. I'm going to be looking for opportunities. So I want to show you one of my favorite charts. that I've been talking about for a very long time. I want you guys to always think about relationship charts, right? I want you to set these up. I don't know if you have bar chart. You can kind of like, there's like a little code in here. At first, you'll be like intimidated. You'll be like, what, how do I do this stuff? But once you do it once or twice, it's easy. And then you create these relationships, right? So let me show you one of my favorite relationships is I actually haven't even looked at this one today. So look at this over the last 5 years. So here's 2021. This was everything going kind of bananas. And then, for years, we just kind of flatlined. So when this chart is going down, fast money, ARK type money, FOMO money is getting out. And the higher quality, higher big cap stocks are doing well, tech stocks. So when it's going up, that means the faster money is doing better, right? The faster money is outperforming. And I said months ago, I said, listen, we want to be watching this line here. This is the line that if we get above here and continue to push up, and we can see this very, very long-term moving average pushing through the 200, that's important, right? We now have a reality, even though we had a big sell-off today. You can't forget that this AI period is going to continue onwards. Now, we don't know what markets are going to do, but we can see here, if I zoom in, we can see that the fast money is very much here, probably to stay. So even look, I was around in the late 90s. I traded that market. I loved it. It was amazing, but it did have sell-offs along the way. But the rallies just kept pushing the market up, 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 up. The sell-offs are going to be violent. We could get a 2 or 3 day sell-off this time. Who knows? But we can see that if we respect this uptrend, which is moving averages heading up, Bollinger Bands heading up, this thing is above that long-term 200 that I mentioned on the multi-year chart. And we can see we're well into this area. We struggled around the breakout spot, but now we are into this new area. So even if we get a sell-off, the bears are going to be like, oh my gosh, of course, I told you we were going to sell off. But I think there's really a possibility we could continue to get something like this, right? Not financial advice, but I think that getting up into this range for my breakout ratio brings this into the realm of possibility, which is going to be, a more of a mania. So I think that's kind of cool. If you like that kind of thing, right? It's gonna come with a lot of volatility. It's going to come with sleepless nights if you aren't positioning yourself right. And okay, so let me see here. Someone asked whether you'd short the VIX when the VIX gets above 50. Okay, that's a good question. Well, you probably mean maybe the VIX products, right? You can't short the VIX itself. The VIX itself isn't tradable, certainly not very easily. But what you can do is you can put on short Vega positions in the VIX futures products. So typically what I will do is when the VIX gets extremely high and it's spent some time up there, is I will start to put on positions in things like VXX, right? So we can see that VXX had a good day. You can see right here is had a good day. Beautiful, beautiful move. I actually have some SVXY that kind of got a little bit hit. I'm going to have to trim. But what happens is this product will basically lose money over time because it suffers from the VIX futures roll. But what you can do is when things get nuts like this, so this is what you guys are talking about there. Who was that? That was Brian and Nina. So Brian and Nina, what happens is when you do get the VIX above 50, and we did get to like, I think 65 in April, somewhere around there, then yes, you can put on positions. The problem with that is the out of the money puts get so expensive. Remember we talked about implied volatility earlier. You are going to see, we call that vol. The option pricing is going to get so massive. The market structure does that. The market makers they'll charge you a ton because they know that eventually this thing's going to come down. it just can't stay up. So that's what you're speaking to, right? You're saying, well, there's, is it safe? Yes. Well, number one, you want to do it with limited risk type positions, right? You do not want to get in there and just short VXX. That's just complete insanity. If we end up in a broken financial environment, this thing could go to 1,000, right? I know that sounds crazy, but you don't want to put yourself in a position where you're just naked short stock or short calls. That's a very, very dangerous thing to do. I'm not saying it can't work. I'm saying you're putting yourself at risk. So what you do is you buy downside put spreads. So what you would do is you'd go out and you'd say, I'm going to buy, like, let's say we were up there right now. I would say, let's say 37 is actually 87. So I would say, okay, well, I'm going to buy some downside spreads. So I'm going to buy like a 34.30, because at that point, the option price is just going to be massive. And the risk is that if you buy those way out of the money puts, this thing could drop $25 and you may actually almost make nothing, right? Because the option pricing will compress. Do you see that? That's why I was talking about earlier with Micron. You have to evolve with the environment that you're in, because when options are super cheap, there's certain things you can do. When options get medium expensive, then it brings into play other things. Then when they get super, super expensive, then you really have to think about other kinds of ways to express your view. You can still express your view of downside or upside or whatever. You just have to do it in a different way, right? So on the way up in May, I did a whole bunch of upside broken wing butterflies in Goldman Sachs, because what happened? We started to break out. We were starting to recover. I was starting to talk about this melt up that were going to happen around 5,600. I started to get really big on that. But the vol was really high, right? So the problem is, as Goldman went up, the option pricing got compressed. So I put on these broken wing flies that basically get you long delta and short vega in the place where you're going. Because once you get up here, then the volatility, the option price is going to get crushed. So it's the same thing with those VXXs, right? It's 100%. It's going to be a good trade probably. There's a really, really good chance it's going to be a great trade. It's just a matter of how long is it going to take to play out. And you've got to play for that volatility crush. So that's going to be downside put spreads. It's going to be downside butterflies, something like that. That's going to not only give you that short delta, which means you're going to make money, right? What happens when you buy a put? You're short delta. You're going to benefit from that product going down. When you're long a call, you have long delta. You're going to benefit. So the delta is just telling you where you're going to make money. Is it up? Is it down? Well, you're going to buy a put here. If you just buy a put, you're going to be short delta, but you're not going to make money because the option pricing just is going to get crushed. If you own a put spread, then you have one piece of the structure that's going to do the compressing, and therefore your delta will not be overrun by option pricing coming in. So those are all these the fun ways to kind of, I kind of get excited. You can tell I get excited about this stuff because I love all these moving pieces, all these, all the different things that happen. And, I was a market maker for a long time. You kind of had to understand this. And we didn't have the computers. I'd look up at the screen and I'd be like, okay, there's a butterfly. That looks good. There's a condor. You had to really think about this stuff fast. Now it's great. It's easy. You could just have a computer tell you all this stuff. Sorry, Matt T. I know I'm a stupid dunce. Bob's here. Yes, Bob's here. Okay. Any other questions, guys? Because I got to go eat something. Do you ever short volatility when the VIX goes? Yes. So we talked about that. What can I look at in terms of options hedging to help my futures? Well, I mean, you can get into options on futures. That's going to be a long conversation, Zigzag, but it's basically, you're going to look at similar things, right? So what was I putting on today? I've been putting on a few positions. Look, I got hurt in some of my long portfolio because I'm not, when I was 27, I would just get in and out of positions. I would never really have big. Now I'm a bit more position oriented, but I got out of a lot of high beta, but I had positions that got hurt. But I was putting on put spreads. So what happened here? We can see this really, really ugly day over here. So I've been putting on some put spreads. The other day, I think in the community, I can't remember what day it was. I said, I'm putting on more of these put spreads. And then today we were down 80 points. And I said, this actually could get kind of ugly today. I said, in another chat, I said, I think this could be a close on the low day. So I actually added a whole bunch more. I said, you know what? I've made so much money lately on all this stuff, all these crap, there's a bunch of crap and some good stuff and bad. Like this has been a fun mania type market. But I said, I've made so much money. I don't mind spending a decent portion of that to continue to play the downside. So I've got a lot of, these were just straight up puts that I bought today. But the other day, I want to show you what you could consider, because what I said at one point was, nobody's used to a sell-off anymore because things just they're just sort of going up, right? They downtick a little and then they go up, and we've shrugged off almost anything. So it's just, and I said, look, from 672 to 660, I said, that's nothing. We've given back like almost nothing. Look at this run. I said, it's not too late to hedge, right? If you've enjoyed a massive part of this run, yeah, of course you're not going to get the top, but you are now recognizing that something's breaking a little bit. Maybe we sort it out, but something is going on. Of course, we know is China and tariffs and all that. And so I started to add aggressively around 660. I can't remember what it was. We were down about 85 points in the SPY. And so what I did is I went in and I gave myself some exposure, right? So let me show you where I position myself. So if you buy short-term options, you don't get a lot of Vega exposure. Remember we were talking about that? The longer the option expiry, the more you have the potential to make money if options explode. Now that's not, it kind of balances out a little bit because the front end doesn't have as much beta, but the front end could go up 20 points, whereas the back end has more Vega, and it's going to go up maybe 7 points, right? So they even out a little bit, but technically speaking, when you're buying these way out of the monies, you want to give yourself a little bit of Vega, right? You don't want next week's options. You want something that's going to give you a little punch when the market comes down. So what I did was I went in and picked up these March 550s. So at the time, I think they were maybe about an 8 delta, So now a 13 delta. But these are options that are far enough out of the money that I didn't have to super pay up, right? I think I paid like 670 or something for them. I think 676. I didn't have to, there's 676. You got to figure out what your budget is. But I figured out my budget, and I said, okay, I'm going to buy a whole bunch of these, and if they go to zero, well, it's like my house insurance, right? I can always decide whether I want to spread them out if things stabilize in markets, but I want to have more of these things, right? I don't want to just sit here. I've got a great saying that I like, which is move your feet. It's hard to do when things get crazy, but I said, you got to move your feet a little bit. And, I picked up a whole bunch of these, but then I also have the 640, 565 spread in March as well, which I talked about on the show. And then in the community, we also did a whole bunch of VIX spreads. We did the 2030, I can't remember what month it was, the 2030 VIX spreads. So those are doing okay too. So I have the ability to monetize. So my plan for Monday before I go is I'm going to watch the market and try to figure out the texture of this market. If I start to look at some of the options, if I see fixed strike vol, so what I do is I use spot gamma and I look at the out of the money puts, and if they're starting to push up, that means fixed strike vol is pushing up. That means there's more panic building in the market. If those out of the monies, if we get a period of calm and those out of the monies kind of come down and the VIX doesn't get too crazy, then maybe I'll start to monetize some of my put protection. But I'm not. The thing is, everyone's always asking me, when should I monetize my put protection? You got to figure out who you are, right? Are you putting on protection to make money, or are you putting it on for it to serve as house insurance? Now, at some point, you want to monetize probably, because then it gives you the ability to put that money back into the market, right? So if I make a whole bunch of money on my puts, I'm going to probably push that into, Google or Nvidia or something that's been crushed. And that's one of the nice things about your put protection. Now, my puts are not going to fix the whole portfolio. But as I said, I'm a position guy. I have reduced drastically. I've made it very clear in my newsletters. I said I've gone from probably 130% in the market, which is levered up, to about 30 to 40% cash, right? So I've already done my delevering, and now the puts are just going to be, protecting what I have to some extent. And then I position again into some of the things that I really, really like. A little bit of IWM. I picked up a little IWM in the aftermarket. So I can't trade the options, right, in the aftermarket. So I picked up a bit of stock here and there. So that's kind of the plan for Mondays, to really kind of get a feel for how things are looking. I feel that there's a possibility that this stress is a little bit durable, but I also feel like we've got earnings coming up. I think they are going to be good. We're going to start off with some banks, and I think they're going to be good, and I think they're going to have good things to say. I don't think the consumer is at least above a certain level is in terrible shape. We had good retail sales numbers. We've had good GDP numbers. Like there's probably a recession at a certain level in a certain level of society. But overall, it's sad to say that the market really isn't reality anymore. I hate to say it, but the market is just, it gets more distance from Main Street, every year. The rich are just going to get richer, and the asset holders are going to get richer. And so they're sort of forcing everybody to buy freaking assets because you can't get ahead if you don't own the stupid companies that are taking everyone's jobs and disrupting the world. So it's a weird scenario. And I'm not like, oh, okay, see you, Willis. I'm not like, like I said, I don't have my head in the sand. I don't think the bears are totally wrong. It's just that they don't often make money because that stuff doesn't translate into making money. This is the world of making money. So we have to figure out ways to make money. And sadly, it's playing what is sometimes looking like a bit of a house of cards built on debt and, inflated assets and all that stuff. But hey, that's the hand we're dealt. Okay, guys, I better get going, but thank you for being here. You know what? Next time I will improve that. Sorry, Steve G. I'm a total idiot for doing that. But yeah, the K-shaped economy, I just think it's going to be so bizarre. And we don't know how the job situation is going to play out. And I don't know if this is my last point, because otherwise I'll just freaking ramble on forever. But thanks, Brian and Nina. Yeah, have a great weekend too. We will try to do this next week. I don't know. Where should I don't even know where I should post this. Just I'll say, I'll put something out and I'll just say, look, I'm doing a show at noon, and then, hopefully people know. But my last point is that, if Powell thinks cutting rates is going to help people, help employment, I'm not so sure. I think companies are going to take that money and invest in all the things that are going to actually, probably not be very pro-employment, right? They're going to look for AI. They're going to look for ways to use technology to avoid having to hire people. So we're in a difficult situation. There's no question about it. I hope that we are correct in thinking that every technological period throughout history has come with a pivot. People are able to pivot. I'm not so sure it's going to happen this time, because AI can kind of do everything. And if you throw in robotics and automation and all that, what's left? What are we going to do? So there is a really, really big risk of societal upheaval at some point, of people being like, what do you want us to do? I have an event schedule in Discord. Awesome. Okay, thanks everybody. I will, for those of you in Leaps Trader, I'll be sending out an alert, I'll be sending out the sheets tomorrow, and I might do a little video for you guys, as well as crypto. But in the meantime, everybody have a wonderful weekend. Thank you so much for showing up. I never know if anybody's going to show up. So thank you so much. And we'll figure out the tech stuff next time. Take care. Hey, it's Shamil. All right, buddy. Catch you later. And Marcus, take care, guys.